Good day everyone, welcome to Earth. In this video, I'll discuss about NRIs who are looking for guidance about investing in real estate in India. My name is Shayan Sharkar and I am the author of Earth. Earth is a website providing you with the right knowledge, tools and one-to-one guidance to create, manage and execute your portfolios in India. Before getting started, please put in a comment below as to what you think about your plans about investing in real estate in India. Before moving further, please click the link in the description section to join our WhatsApp channel to get notifications about the site and know about upcoming webinars. Let's get started. Why NRIs should invest in India is a topic about specifically about real estate is something that I've covered before. I'll leave a link to that video in the description section. This video, however, is going to cover a list of all items that NRI should keep in mind, whether they're either buying, maintaining, selling property in India, where to find property, how to buy it, what are the various taxation rules, what do you need to keep in mind when you're selling, how to repatriate money, all that. So we're going to cover location and type of property, buying in India, managing the property once you purchased it, selling and TDS related rules, repatriation and tax related rules, and what about land, urban, rural, agricultural, all of these points. So if you look at the location and type of property, so the basic location and type would be an independent house where you own the land. It allows you full customization regarding what you want inside, what kind of floors you want, what kind of interiors you want, what kind of walls and interior layouts you want. All that customization is present. It gives the benefit of land ownership, and you can create security as and when you like. Either you can put a security guard, or if you're inside a gated community, that will be protected accordingly. That being said, if you go to into a project where it's a housing complex, so the first and foremost is you buy what is available. But there are other facilities which are available, like a gym, a swimming pool. Some might even have saunas. Nowadays, high-end projects are coming up with restaurants, community centers. All of those facilities are present. And of course, you'll have the ability to mingle with exactly the type of people that you do want to mingle with. So that is a gentry. So that's the benefit a project offers you. That would likely not be an independent house. And where to buy these? So tier 1 and tier 2 cities, both in terms of infrastructure and the facilities that we're already used to outside India. So we'll get that in tier 1, tier 2 cities, at least more than you would get in, let's say, in a tier 3. So unless you have a very compelling reason why you want to settle outside tier 1 and tier 2 cities, so this is something that you would keep in mind. Uh, Next point is about land. So you can always buy land of your own somewhere and build a house on it. Main problems with that is security, housing, keep that safe from encroachments and all that. But if your purpose is investment and getting investment returns out of it, then you need to keep in mind that land does not offer any kind of diversification at all. So you buy one plot of land, it's there somewhere in India. You might visit it sometime when you're coming to India, maybe once every 2 years or whatever. So you really can't keep that safe. So all those aspects are there. I'll cover that in the later slides. But coming from the point of diversification, one plot of land in India somewhere really is not a way to create a diversified portfolio. You can buy 10 different lands in different cities or states of India, but then managing such a property is difficult. So land we're going to skip just for the time being. We'll focus on independent houses and housing complexes. Moving ahead, what are the rules about buying property? First and foremost is TDS. So anybody buying property in India has to deduct TDS. So when you buy, whether you buy from a resident Indian or another NRI, you have to deduct the TDS. The TDS goes to the government and the rest goes to the seller. So if it's a resident Indian who's a seller, the TDS is 1%, and this is above property, which is 50 lakhs or more. Below that, there's no TDS. But if you are buying from an NRI, so the TDS is much higher. You want to cover that in the aspect where NRIs are selling property, so the TDS is much higher. Next is GST. GST is only there for under construction properties. Ready to move obviously doesn't have GST. It can be 1% if the house is cheap. Usually 48 to 50 lakhs is the threshold for affordable housing, and that's where the GST is only 1%, or it's 5% if it is above that particular value. So this is only for under construction. This is not something that you have been ready to move. There's no GST there. Stamp duty registration costs, obviously, this varies from state to state, 5 to 8%. Typically, in some states like Haryana, for example, Women have lower stamp duty and registration costs if you register the house in the name of a lady in the family. If you do it jointly, it would be somewhere in between. And if you do it men only, then the registration cost is the highest. So it varies. It's a state to state, but it's there in all the states. Home loans, yeah, NRIs can get home loans in India. The documentation process is same, but along with standard residence and address proof. So your resident proof will be your abroad residence. You have to provide a copy of passport and all that. PAN card is obviously required. So home loans are possible. Good banks, all the standard major banks in India will provide a home loan, and you can pay off that home loan from your NRI or NRI account. So that's not a problem at all. So getting a home loan sanctioned to buy property in India is fairly straightforward. Last bit about buying a house is power of attorney. We'll cover this in the selling bit also, but keep in mind that when you're buying a house from a seller who has a power of attorney involved, that power of attorney must be a specific power of attorney. And by specific, it means it's only about that particular property. It cannot be a general one. There's a lot of risk for fraud, and it should be, that's why it should be specific only. So those are the main rules of buying property. So obviously, there's a lot of background work that goes in buying the property. Once you shortlist an property, and you need to ensure that the documentation is all there, the income certificate is present. You need to you should hire a property lawyer, someone who's accustomed in doing all of this, and to give you a clean check about the particular property. That's only important. And if you are buying from a builder, so buy from tier one builders only. Good tier one builders in India with good track record are available. Most of these are listed companies. The biggest names are listed on the stock exchange, so you can buy from them. That would give you not only surety about the quality of the land, the title, the records which are present, and the track record of the builder itself in delivering projects on time. So that's something that you need to keep in mind. We'll move on to the next bit about managing property. Now, after all of this, if once you're finally landed on the property, so you need to keep in mind that distance, that you are not in the same country as a property itself, that brings with it challenges. First and foremost is power of attorney. Again, what is the purpose of power of attorney? Power of attorney, and again, it's the same point, has to be specific power of attorney. Generic power of attorney is not allowed. So specific power of attorney for that particular property allows you to allow somebody else in India, for example, a family member or friend, to take decisions on your behalf. So when I said decision, this is only a signing authority. Let's say you are selling by power of attorney, so it will only, the money will come to your account. The person, the power of attorney holder in India, they will be able to only sign on your behalf, and that's it, nothing else. So I have a detailed article on power of attorney which I'm linked in the description section. So this is power of attorney. Having obviously a caretaker is important. Somebody is going to keep the house clean, do small maintenance work. Obviously, you can't do maintenance like bulbs going off and painting the house, all that. You can't do it from abroad. So need to have a person to take care of it as a caretaker. So nowadays, we have property management companies coming up in India as well. Some are good, some are bad, like all typical. But those are options where professional firms are doing this work. You can look for them, and they will take care of a property, and they will deduct a fee for the services and give you the rest of the money as rent. But keep in mind that if you're given house on rent, there's always TDS involved in case the owner is an NRI, which it would be in this case. And the caretaker or the property management company will take care of the local laws and regulations and taxes, property taxes, and that. So that's something that needs to be kept in mind. And of course, the rules regarding repatriation are there, so I'm going to cover that in the next section. So once you, if you have property in India and you want to sell it off for whatever reason, so you need to keep in mind the first and foremost thing is that you need an NRO account. So that's where the proceeds of the sale, the money that you receive from the seller, that's where it will arrive into the NRO account. So there's no role of NRD account. In the NRD is for money that comes from outside India. So money that is coming from India, whether it's property sale or dividend or interest or share sale or mutual funds, that comes into NRO. So typically you get an NRO account because before you went abroad, you would have had accounts in India. Those get converted into NROs. So that's fairly straightforward. Every NRI should have an NRO. And you can't have obviously resident Indian accounts as an NRI because that's a FEMA violation. We're going to talk more about FEMA as well. So TDS, I briefly touched upon TDS in the previous section of the video. TDS is the government basically wants to ensure that when you sell an capital asset, so when capital asset, any property, stocks, mutual funds, all of these are capital assets. So when you sell it, there's tax due on it. The tax typically you would pay it at the time of filing a tax return in India. But since NRIs typically don't file tax returns in India, this TDS concept comes into place. Tax get deducted by the buyer directly. So the buyer, what they would do, let's say the TDS, hypothetically, just the math simple, the TDS is 10%. So it's a 1 crore property, TDS is 10%. And what would the buyer do? The buyer will take the 10%, give it directly to the income tax authorities and give you the remaining 90 lakhs. So that's how TDS concept works. So when we discuss offsetting TDS and with capital gains, all that, but this is how the basic premise of TDS. So TDS depends, the rate of TDS depends on how long the property was held by you before selling it. So there have been some changes in the current budget, in the 2024 budget, which came in July. So the threshold for capital gains, whether it is long term or short term, is currently 2 years. So 2 years, more than that 2 years, it is long term, it's 12.5% TDS plus surcharge and cess. Less than 2 years, it's short term, is 30% TDS plus surcharge and cess. And the way TDS is calculated is TDS is calculated on the capital gains amount. Let's say you bought a house for 40 lakhs, let's say 10 years back, and you're selling it today at 1 crore. So the capital gains amount is 60 lakhs. No indexation. Indexation was recently removed from for NRIs in the budget itself, this budget. So you, it's on the capital gains amount only. So, but in case you don't have records which about the purchase price of the house, or the records are not there, then you will be converted. The TDS will be calculated on the entire sale proceeds, so it's much higher. So the basic premise here is you have to file your income tax return in India to get back the TDS in case the capital gains amount is lower than what the TDS is. So you have to file the return by 31st July of the next year. So in India, the tax season is from April to March, and following July 31st July is the deadline to file the return. So you should get hold of a CA in India who will do this work for you to get the return filed so that you will get back the TDS. So this is all automated. So once the return is processed, you come back to you. Budget 2024 changes were pretty substantial. One of the first things that the budget did was get rid of indexation. So indexation was allowed you to get the lower capital gains tax. Indexation was removed for NRIs, so it has been retained for resident Indian selling property after the budget. So that is a big change. And it has changed the TDS rates as well. Earlier TDS rates were much higher, 20% and above, plus surcharge and cess. Now it has been reduced to 12.5%, but this 12.5% is again slab wise, so 50 lakhs to 1 crore, depending on the price of the property, rather the profits of the property, and it goes up from that perspective. So this is the rules on selling a TDS. Once you have obviously sold it, you have to repatriate the amount to your home country. This can be complex or simple depending on the competency of the CA that you have hired. There are a few rules around it. Like I said, NRO account only, no role of the NRI account. The money will come to your NRO account after TDS has been deducted. And a very important point here is that to ensure all of this works correctly, your PAN, which is your PAN number in India, which you use for income tax filing, should and must be marked as NRI in the income tax portal. So your CA will guide you. The basic premise is to send an email to the the assessment officer of your particular income tax file and ask that person based on the documents that you provide, so passport and all that, to ensure that your PAN is marked as an NRI PAN so that you don't have a Aadhaar linkage requirement, and then the TDS can actually work. Next is the repatriation has a 1 million USD per year limit. So the year again is from April to March. So if you're remitting within this amount, it's fine. If it's more than this amount, maybe you can split within 2 financial years and then remit it that way. So that's doable. The CA involvement comes in because you need to submit a form called 15CB, which says that the tax has been paid and all that, and the bank would require another form of CA that you can submit yourself. That's the process of getting the repatriation done. And DTA, double tax avoidance. So the way the concept of DTA is that for a one particular transaction, if X is the amount of tax that is due in India, let's say 10 lakhs is the amount of tax which is due in India, and 15 lakhs is the amount of tax that is due in the US, and you have already paid the 10 lakhs in India. Only the difference, which is the 10, 15 minus 10, 5 lakhs will be due in US. You don't have to pay again 15 lakhs full amount in US for something that has happened. So you don't have to pay tax on the same thing twice. So you pay only the delta, which is the period of the two amounts in the two countries. So that's how TTA works. Again, your CA will help you so get benefits of TTA. Next comes to land. I left till the last because land really has a bit of complexities. First and foremost, FEMA, Foreign Exchange Management Act, doesn't allow NRIs to buy agricultural land directly, so that's not allowed. And skirting this regulation is not something that is possible or even recommended because you really would get into trouble with FEMA, so that's not advisable. Urban or rural non-agricultural land can be purchased by NRIs, so that's allowed anywhere in India, non-agricultural. And you can inherit any kind of land, including agricultural land, from any resident Indian. So this inheritance is allowed. It's just that you can't buy agricultural land by yourself. So that's not an option. And there are a few risks about land. One is the clear title should be there. You need a property lawyer. You have to ensure that there's no encroachment, which would obviously take your land away from you. And I mentioned the point of diversification. You can't diversify your portfolio by having one piece of land somewhere. So that's not something that will happen. I'll now cover some bonus tips. Selling of land or real estate, houses, everything allows even NRIs the benefit of Section 54 of the Income Tax Act. So Section 54 allows you to save taxes by investing up to 50 lakhs of the profit into certain government bonds. So that's allowed. Next is buying. Section 54F is also applicable to NRI as long as the property is in India, of course. If both these sections are for properties in India, so we can't. This is not for properties buying, purchased or sold outside India. So this is for India. So 54F is an amazing thing. Basically, let's say apart from property, if you sell, let's say mutual funds or stocks or anything like that, another capital asset to buy a new property in India, right? Then you don't have to pay long-term capital gains on that particular sale. So you want to buy a 2 crore property in India and you have stocks in India or even stocks abroad and you sell that and within a year you buy property. So any profits on that particular share sale that will not be that can be offset because that can be you don't have to pay tax on it. So that's how it works. 54F is available for NRIs also. The property new property has to be in India. That's the only condition. LDC, this is lower deduction certificate. This is related to TDS. Uh, if you believe that your capital gains on the property is lower than the TDS amount, you can get hold of a CA and file this Form 13 and hope that the assessment officer allows an LDC for you. Then you don't have to pay the full TDS. It might be simply easier to wait till 31st July to the returns and get back the TDS amount. But if you have a timing constraint about the amount, then you can try to get hold of a LDC. Again, a good CA pay would be very helpful. And one point is about 31st July. I've been mentioning this date a few times. So this is the date by which tax returns have to be filed in India. So why is this important? One is TDS. If you want to refund your TDS, you need to file your tax returns by this date. Second is if you are doing buying and selling properties and you want to get a tax exemption either on or either for 54 or 54F, and if the previous transaction has happened before and the next transaction happens after, then you need to put the amount in a capital gains account scheme, CGS account. So I'll just clarify with an example. So let's say you bought you have sold on 1st of January of the year, you sold 1 crore of mutual funds, and using that money is now there with you, and you want to get capital gains exemption. But the house that you want to buy, you can buy it only on 1st of October. So the 31st July would fall in the middle. So this entire 1 crore that you have got from a mutual fund sale which you want on which you want to get a 54F exemption, that has to go into a CGAS and sit there until when you are actually planning to buy the new house, which will be in October, and then you take it out from the CGAS and then um, buy it. So that's the only way to get the exemption. This is the rule of 31st July. So yeah, so that's the whole thing. Thank you all for listening, and I'll see you all in the next one. Bye bye.